to our third quarter 2026 Guide to the Markets web conference. I'm Tai Hui, I'm the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and I'm, as always, delighted to be joined by my colleague, Kerry Craig, who's our Senior Global Market Strategist based in Australia. The two of us are going to walk through some of the key market themes that we think are relevant to investors, not just for the third quarter, but really for the rest of this year, as well as going into 2027. Clearly, this has been a very noisy year when it comes to markets. We've got the war in the Middle East. We have a lot of new developments in artificial intelligence. And at the same time, I think the Fed's policy is coming into view when it comes to where policy rates could be for the rest of this year. So over the next, hopefully 30 minutes or so, Kerry and I will walk through some of these key questions for you. As I mentioned earlier, it's a very noisy year, but at least in terms of market performance, it's a pretty decent year. Clearly, equity markets have shrugged off a lot of the uncertainties when it comes to the Middle East, and really focus on AI, especially when it comes to hardware and semiconductors. But clearly, there are questions about whether some of these rally have gone a bit extended, a bit overstretched. So in our mid-year outlook for 2026, second half of the year, our key theme, just to be consistent with the World Cup theme, is don't park the bus, which don't be too defensive. I think there's still plenty of opportunities for investors to generate returns, but very much it's not only about technology. I think there are other areas which we think are worthy of your time, worthy of your capital in terms of investment. So let's start with the sort of the macro big picture, where we are in the US, and also where the Fed's likely to be in the second half of this year. So obviously, I think the big question we have right now is, how does the war in the Middle East impact on gasoline prices, on energy prices, and of course, in terms of growth? Where you can see on the page right now, on page 25 of the Guide to the Markets Asia, you can see in the past few months, clearly fuel, gasoline, energy have contributed to a significant pickup when it comes to inflation. The right-hand chart, you can see the purple bar really lifted the headline inflation. The good news is we've yet to see really a U-turn or acceleration in underlying inflation. And our view is that as we approach the summer, as you've seen gasoline price in the US, it started at below $3 before the war began in late February. It hit peak on average $4.50. Of course, again, that gasoline price does vary from city to city, region to region, but on average for the whole US, average is around $4.50, and now it's back below $4. So what we expect to see is that the inflation index is likely to ease back a little bit in the coming couple of months. Of course, it is still likely to be a significant year-on-year growth in consumer prices as we approach the end of the year. But nonetheless, I think the peak of inflation is with us right now, and we expect headline inflation to ease back a little bit towards the summer months and into the second half of the year. That will give the Fed a little bit more room for maneuver. Now, of course, the growth momentum in the US economy continues. AI CapEx spending is still very robust. Consumer spending is holding up okay, but as you can see on the left-hand side of this page, page 23 of the Guide to the Markets, the job market is in pretty strong shape, despite the latest slightly weaker non-farm payroll data. But even then, the last 3 or 4 months on average, the US economy is creating over 100,000 jobs, which obviously defies that weakness that we've seen for much of 2025, and then unemployment rate continues to be relatively low. So I think the good news for the US economy is a lot of the uncertainties coming from the Middle East is starting to fade away. Of course, the ceasefire between US and Iran continues to be fragile, but nonetheless, the Strait of Hormuz is gradually being reopened, and that helps to reduce, not eliminate, but reduce some of that stagflation concern in the economy. And at the same time, the US economic momentum, the underlying momentum, continues to be pretty solid. So I think, from a macro standpoint, that clears up some of the uncertainties in the economy. Hopefully, that brings us to a broader set of earnings growth across different sectors, not only focusing on technology, But we'll come back to what does that mean for markets in the third part of our presentation. But Kerry, on that note, we've got inflation rolling over hopefully in the coming weeks and months. Still a job market on balance. Where do you think the Fed's likely to be between now and the end of the year, but maybe also going to 2027?
Thanks, Ty. And good morning, everyone. Thank you for joining us on this call. I mean, it's a great question, Ty, and we've obviously been debating it a lot in our own team around the direction of the Federal Reserve, especially with the new incoming chair, Kevin Walsh, very much changing views around the communication style that will be there, moving a forward guidance, and obviously implementing a number of task force that are there to look at how the Fed communicates, what the data is that it looks at, and a variety of other things. So there's a bit of a shift in terms of trying to interpret what the Fed is doing. Certainly, as you've outlined, if we look at the economic backdrop, we see that labour market that remains fairly tight, just taking into consideration the unemployment rate as being relatively low still compared to history and for where we are in the cycle. And then, as you mentioned, thinking about an inflation rate that's coming down from a high level, peaking now in the middle of the year, and some of those disinflationary forces being at trend, but still that year-on-year comparison being, I guess, a little bit uncomfortably high for the Fed. It's that concern around it becoming sticky. So when we think about the Fed from here, balancing off those two factors in terms of, what looks like a labour market that's not sort of moving into a period of prolonged weakness, keeping the consumer sort of going, keeping the economy ticking over, and at the same time thinking about inflation that is coming down, it does feel like the Federal Reserve in our mind would be just watching those two forces, and that should be enough to keep them on hold throughout the course of this year. So a little bit different than when we look at the market pricing, which is still biased towards the upside for rate hikes. We would argue that the Federal Reserve is both likely to wait for what those task forces say, also likely to wait to see how the economy reacts to these lower energy prices and some of the, I guess, offsetting shocks from all this AI CapEx spend coming through. And that's why that story, as you mentioned, becomes much more around 2027 and whether the Federal Reserve will actually move higher rates or cut rates in that environment. Our bias at the moment is to probably see them ease rates back then, but that communication style changing makes it difficult to interpret that. And if anything, adds to a little bit more of that rate volatility in the coming quarters as we think about it. And so I think this chart's really useful when we think about not only just the projections that we see there for the Federal Reserve in the long run and how they're thinking about the economy, which is one where the unemployment rate stays relatively steady. You see growth that sort of maintains above 2%, which is, good trend-like growth, and then an inflation rate that is peaking this year, but then continue to come down. Why they would need to move rates a lot in that environment, and they don't. So you can see this grey line goes through these cycles of either a number of rate hikes or a number of rate cuts. And really, in the time span we're showing here, it's only that sort of 95 to 99 period where you've seen like these small adjustment cuts come through. Back then, the Federal Reserve was trying to, work on its reaction function as it is today. It was evolving during that period. They were thinking about how they would create somewhat of a soft landing, as well as thinking about these insurance cuts they were putting in place. And so that's why you see these cuts with only a couple and then a rate hike. And that's, I think, the challenge today, just justifying really what would happen if the Federal Reserve were to hike rates by 1 or 2 or cut rates by 1 or 2. And given that these cycles usually move in much more meaningful moves in terms of where that rate goes, it does feel like 1 or 2 rate hikes or 1 or 2 rate cuts isn't going to change the macro narrative greatly, or therefore the market narrative a long way. It does keep us a little bit short, or at least neutral when it comes to duration. But I think beyond that, it's not really something that offsets that case that you've laid out at the start for thinking about the opportunities and growth assets that are out there, and really thinking about where we're heading from today in terms of these big tailwinds we have in the economy around AI CapEx and that broadening out we're seeing, especially now as we think about energy prices moving back down to where they were prior to the conflict. So again, it's no real big movement from the Federal Reserve this year. I think the question really is about what they do next year, and that ultimately is data dependent, as we all know, and thinking around where that unemployment rate goes, how much that inflation rate comes down, and then thinking about the forward guidance the Fed typically isn't offering anymore, but does seem to be biased towards wanting to get inflation back towards its target rather than thinking about the unemployment rate overall, Ty.
Thanks, Gary. I think that's a really interesting take on the Fed because ultimately, as you already said, I think there's a lot of concerns about what could trigger a more challenging time for technology or growth stocks. Of course, I'll come back to the question of the demand for data centers and AI developments, but the rise in fund or the risk of higher funding costs, high interest rates could also be a factor. But as you rightly pointed out, I think the Fed is quite happy to maintain its current stance and just adopt a wait-and-see approach rather than rush in to raise rates like we've seen, for example, in Europe or some of the other developed economies. So look, the next topic I want to talk on is obviously on AI. The chart you see right now, this is for Asia Pacific when it comes to market performance and also corporate earnings. And what you see here is a rotation from about 24, 25, where both the US and APAC hyperscalers did really well back in 24 when AI really started to capture the imagination of the markets. But that AI hyperscalers momentum started to slow down again in the US in late 2025 and in 2026. We've seen semiconductors and hardware really took over. So you can see on the left-hand side, both 25, the dark blue bar and the light blue bar representing the semiconductors and hardware did really well in 25, but did even better in 2026. I'm sure now everyone's familiar with the Taiwan semiconductor industry, as well as the Korean memory industry, memory chip industry leading the way. But the important point to recognize is if you look at the right-hand side, this is not just built on hopes and dreams, but this is actually built on solid corporate earnings. You see again, both in 25 and 26 year to date, the light blue and the dark blue bar, the two sides actually match each other quite well, which indicates that investors have moved away from hyperscalers, promising the future of AI to semiconductor hardware, which they are servicing these hyperscalers through data center constructions, through data hardware demands. They're actually generating revenue and earnings today. So I think investors are moving away from an aspirational idea of AI towards a more instant gratification when it comes to the pick and shows, as we call them, when it comes to AI demand. Now, going forward, I think there are a couple of things to watch out for. The capex intention is there. So if you look at this page of page 49 of the Guide to the Markets, the capex intention and on both in the US and in China, they are there. And companies are investing a larger share or larger proportion of their free cash flow in order to fund those infrastructure developments. That said, I think there are a couple of things, a couple of risks to watch out for. First of all, obviously the rising costs of these type of infrastructure investment because of the shortages in semiconductors, in memory chips. The construction of data centers is on the rise. The availability or the shortage of electricity, especially in the US, that is also a concern. And finally, public opposition towards data center constructions in the US is also gathering momentum. So from that perspective, I think, whether US hyperscalers can really execute those capex plan, obviously the intention is there, but there are some challenges facing them. And again, they may not have to build in the US. We've seen they're building in Europe, they're building in the Middle East, building in parts of Asia in order to serve their customers. So again, the demand for hardware and semiconductors is likely to be well supported. It's just that, the actual delivery or the actual execution of capex spending may be a bit more bumpy than people expect. That's the other point. And at the same time, as a result of that, as we've argued for really much of last year, why we've advocated for Northeast Asian markets since late last year is, again, a familiar chart hopefully to everyone. On the right-hand side, you've got Taiwan and South Korea being very dominant in the production of memory chips, such as DRAM, as well as logic chips, especially the high-end variety. So when these companies are facing short or when the availability of these semiconductors are facing shortages, the bargaining power of the makers are looking really strong. So when we think about the risk towards Northeast Asian markets like Taiwan and South Korea in the second half of the year or in 2027, I think there are three possible scenarios. One is a sharp pullback in CapEx spending by US companies. That does not look likely for the time being. Yep, we have seen individual companies readjusting their strategies, but the pay-to-play mentality, I have to be investing to stay in the game. I don't think that's changing anytime soon, at least for the next 12 months. Number two, are we looking to expand or are we looking at an increase in capacity? Again, these kinds of factories that make semiconductors as well as memory chips, they can't be built in 3 months or 6 months. They have to be built over a long period of time with significant investment. And again, testing, retesting to make sure the yield is decent. So again, the capacity expansion is not really a real risk for 2026 or 2027. It may be a challenge going further beyond that, but again, where we can have some visibility over the next 12, 18 months, that looks to be in reasonably good shape. Finally, additional competition. As you can see here, Korea and Taiwan, they're not the only companies that make semiconductors and memory chips. China too, but China may not be in that high-end category like Korea and Taiwan at this point. And for them to move into the high-end category, a lot of the export restrictions that we see today is a huge stumbling block. So I think in the high-end, things like high bandwidth memory or the 2 nanometer semiconductors, Taiwan and South Korea, at least for the next 12, 18 months, continue to enjoy a really strong advantage. So when you kick the tire, when you try to do a bit of a quick check on what could go wrong, I think the position that we see right now continues to be solid, at least for the next 12, 18 months. Of course, beyond that, capacity can grow, CapEx can start to get pulled back and reduced, but at least for the time being, we would argue the fundamentals of Korea and the Taiwan market continues to be in good shape. Now, the other thing to watch out for, of course, in terms of risks, is the adoption of companies now by enterprise clients. So what you see on this page, especially the right-hand chart, which is a new chart, is that different sectors, they're adopting AI at a different rate, but you can see all the lines are pointing up. So what that means is whether you're in technology or media or something a bit more manual like construction, companies are using AI and they're using it in different ways. And I would argue that with robotics, with autonomous driving as potential facilitators, you can see some of the more manual work like construction or manufacturing also start to adopt AI more aggressively. Could be 3 or 4 or 2 or 3 years down the line. So when we get asked a lot about what sectors or what's next for AI, of course, as I mentioned earlier, semiconductors, hardware, we think should still be in the sweet spot, but things like robotics, such as autonomous driving, I think these are the areas which we think could see a lot of investment, a lot of developments, and the ability for that to combine with AI and to be adopted by sectors on the left-hand side of this page. At the bottom half of that page, things like retail, things like construction, accommodation and services. You need robots, you need a physical infrastructure to support the development. So I think that's another thing to watch out for. And at the same time, in terms of the service sector, I would argue that research-intensive sectors, things like biosciences, things like chemical engineering, things like machinery design, all of these, again, can benefit from AI accelerating the research process, reducing costs, reducing the requirements of human resources. All of that, to me, continues to be bright spots in terms of investing and opportunities. So while we are seeing some companies starting to rationalize how much budget they have for AI, so I describe that as from CTOs to CFOs, the tech officers wants to obviously use AI as much as possible, but the financial officer have to watch the budget, and the cost of token is a contentious issue. And therefore, I think we'll see companies start to balance between adopting AI as a way to progress and move forward, but at the same time being a bit more mindful on how much they spend. So that again comes back to the question of how hyperscalers can monetize AI. I think the direction of travel continues to be positive, but there's not an infinite budget for adopting AI. I think we have to be realistic in terms of the level of growth we can see. But nonetheless, I think AI can, on the next stage, open up a lot more AI users that I think the market will start to focus on, rather than just the developers of AI or the facilitators of AI. I think the next stage is going to be more on the users. Kerry, now, if we come back to the question of hyperscalers and companies that are now investing in the infrastructure, one question we get asked a lot is how are they going to fund it? We touched on this very briefly about the concerns over funding costs. That does not seem to be a huge challenge right now because the Fed's likely to stay put. But should we be concerned about how AI hyperscalers or related industries are funding their rapid expansion?
I mean, that's a great question, Ty, and one that's come up more broadly. So obviously over the first half of the year, as you've seen, a big run up in some of the equity markets around the world. Some of the correlations between markets become a little bit more positive as things become a bit more tech and AI related. In equities, that's also sort of raising concerns on the fixed income side, because all this debt issuance we've seen come to market this year from these hyperscalers to fund all this capex. Obviously, in the beginning, when they were using a lot of the existing cash balances to fund that build out, there was no real concerns. There were big cash rich companies that could do this. And so only recently in the last 2 years have they actually started issuing debt, which makes sense. We think about their balance sheet and how they're approaching capital markets. You can see the left-hand side of the page just showing the debt issuance by the US hyperscalers. That's through 2025, that big bar. Year to date, they're about 165 billion, so it's continuing to rise. And there's been some very large, notable issuances by some of the hyperscalers this year. But again, it makes sense. If you're all looking at the rates market, wondering where yields are going, where the cost of that debt is going, and you think potentially it's going to be higher, you try and get in early and issue that debt now, because it does mean in the future you don't have to do so at a higher rate. You can use other means such as share issuance or anything else to try and build in that growth that you need and fund that growth. So it's a relatively healthy development by that point. It also is worth noting that, like on the AI CapEx chart we showed, or this one here, when we think about that as the share of the operating cash flow, it's still under 100%. So they still have the money there to pay for these things. They're just using the different funding sources they have available to them to do so. So it actually is, again, a very healthy market. I think the concern here, though, is around the growing share that this represents within either investment grade or high yield, or even in the private market space where tech was always a larger factor. And so you can see that on the right-hand side, just how big it is becoming within these sectors. And so it does mean that when we're thinking about how this AI trend is impacting markets more broadly, our concern is not the quality of what's being issued. It's not the concern around these companies being overly levered and having too much debt and posing a risk. It's really here about the fact that we're thinking about how you have better range of diversification, how you ensure that your portfolio, when you're wanting to own some of these high quality, safer assets from investment grade, you're just not levering in and layering into more and more of that tech theme. So index buying and just buying the index will obviously give you that to you on fixed income. Being much more active across the space is a way to actually limit it in terms of thinking around how we make sure that diversification benefit is genuinely there. So I think this is a theme we're seeing play out, not just across public markets, but also private markets as well. And I think, again, it's just when we come back to that portfolio construction angle and thinking about, we are aware of some of the risks you see in the private equity side, or public equity side, we also need to bear in mind how that plays through in terms of the defensive assets and those quality assets that we hold to allow us to have that risk on bias to ensure we're not adding into that theme. But for us, it's not really an issue in terms of an oversupply, in terms of investment grade. It's been digested very well by the market. There seems to be ample demand for high quality investment grade assets, especially as the markets are a little bit tepid towards owning a lot of longer duration government bonds at the moment, given that inflation view and concerns around where rates are going. So these assets are being well supported in this environment, and we don't really expect that to change given that positive view in terms of the macro backdrop, given the earnings that are coming through are really supporting, these quality assets in this environment.
Great.
I think moving on from there, though, obviously, as we flip to the other side, is around thinking about the equity market and some of the concerns we've seen on concentration risk, but also in the broadening out of the theme, Ty, that you mentioned back at the start of the call, thinking about how we're seeing, the recovery coming through from lower energy costs, how that should be supportive of growth around the world, thinking about the continued tailwind from this AI capex broadening out, particularly within markets like the US and globally. And it's also interesting to note that, this year, the equity market has been fueled by earnings. That earnings growth has been higher than you've seen in terms of the price appreciation, quite clearly from that earlier chart showing the Asian hyperscalers. And you can also see it here on the left-hand side of this page. We look at the PE ratio for, say, the Mag 7 versus the rest of the market. That PE ratio is actually falling because there has been that movement and rotation away from the hyperscalers, but the earnings have still been relatively robust. And so you've actually seen that D-rating come through. Cast your mind back a few years, and it was the case like, are these things too expensive? They're actually looking probably the best attractively priced they have been for a number of years now. And so while we think about that rotation to picks and shovels, or we think about that rotation in terms of following where all that capex money is going around the world, I think the hyperscalers themselves, given the prices, will still be somewhat attractive in this environment. But that broadening out we're seeing, I think, is very clear when we look at the earnings growth chart here on the top for the US, the Mag 7 versus the rest. You can see that the second quarter 26 number, still big expectation in those green bars for what's coming out of the Mag 7 and into the third quarter. But that grey bar, which is the rest of the market, is steadily building up over the coming quarters as some of these headwinds are starting to fade, particularly the pressure on households in the US from the inflation outlook and the fact that the labour market is still quite good. So I think when you think about where the growth in the economy is going, there's definitely opportunities outside just the tech names in terms of what we've seen in some of the industrials, particularly the onshoring that's continuing to happen in the US, the build out of a lot of the infrastructure that supports this, or even thinking about the financials. Again, credit growth looking pretty good. We continue to think about steeper yield curves in the US, which support financials. There's definitely other opportunities which are coming through in the US context and more broadly around the world. A very common question we've had over the last 3 months is like, yes, I know a lot about AI. We hear a lot about AI. What else is there? It can't just be all about AI. And it's not. And so this is a great new page in the guide to markets for Asia for this quarter, just looking at some of those other global investment themes, which probably aren't getting as much airplay as they deserve, and how well they've been doing. So the left-hand chart just shows you the return across some of these themes, and that green line there, obviously the story around the Asian semis being very dominant. But some of those other themes, European defence, that has obviously been something that's been very prominent given the rise in geopolitical concerns we've seen around the world, some of the movements around funding of NATO, a big pickup in terms of European economies funding. There's always been these questions about capacity, capability to do that, which has taken a little bit of the heat out of the market. But I think you'll start to see that as an area which is continuing to perform in terms of thinking around a secular theme around the need to have better defensive capabilities as the world becomes more fragmented and these geopolitical events seem to come more frequently. And there's other things like the banking system around the world. Again, I'll point to Europe. I mean, that was always the pain point in Europe. A lot of bad debt overhanging from the European debt crisis. A lot of that has moved on. We are thinking about, again, a steeper yield curve or a better outlook for fixed income and rates in Europe, which does mean that the banks generally make more money in that environment. And so you've seen international banks outside the US continue to perform very well there in that orange line. And there's other ones to note as well. Everyone focuses on US growth. That's the grey line on the left. Just look at how Japan value has been doing relative to that story. A lot of that's coming back to that corporate governance changes coming through. But if it's a very growthy sort of tilt to portfolios with all this AI story, then a bit of value doesn't hurt in terms of trying to balance that out. And you have seen that being playing through in the Japanese market. So when we look at the sector breakdown across the world, yes, a lot of markets do have top 10s that are dominated by tech names and a very high allocation of consumer services and tech towards those sectors within markets, but Europe is a much more diversified market. Japan has a much more diversified market. So I think there's definitely other secular themes that we can think about in portfolios that are playing through, as well as other markets which generally do build in that diversification. And again, just like on the fixed income side, ensuring that those portfolios are robust enough to support the outlook, where we are seeing better growth, but we are aware of some of those risks out there, particularly as you outlined already, Ty, around the delta in that CapEx story. So those CapEx numbers are very high, but the market might be sensitive to any disappointment or revision of those CapEx numbers in the future.
Thanks, Kerry. So I think the other thing to bear in mind is when you think about asset allocation, so Kerry touched on the equity side, both the US tech as a focus, but at the same time, the importance of broadening out your allocation beyond technology into other sectors, riding on solid growth momentum, as we said at the very beginning, and also some of the investment themes, whether it's defense or financials or Japanese value stocks. So beyond that, I think the other important consideration is obviously the role of income. We've argued since the start of time, that income plays a critical role in asset allocation and portfolio constructions. For some people, it's an important source of spending power, especially for retirees. But at the same time, the importance of income compounding to generate return in the long run is often underestimated or understated. Now, the other important thing to bear in mind is you think back to the last 6 months, of course, everyone's talking about the fantastic performance of equity markets, especially in Asia. And as a result, that 5, 6, 7% income from fixed income may not look that attractive. But as we rationalize or become more realistic in terms of return for the second half of the year, where we're still constructive, but at the same time we're realistic, then we're not repeating what we saw in the first half of the year, that gap between equity return and fixed income return is likely to converge to some extent. And again, don't forget, fixed income typically has a lower level of volatilities and meanwhile generate income for investors. So what you see on this page right now is, again, hopefully familiar, is the level of income that we can generate from government bonds, from investment grade corporate debt, from high yield corporate debt, as well as Asian and emerging market fixed income. There are pros and cons for each of these categories, but as Kerry rightly said at the start, when we think about government bonds, the long end, of course, we can argue and debate what central banks are going to do, but overall, developed market governments, they do have some fiscal challenges, and that could keep the long end of the yield curve relatively volatile. So you may want to stick with a short to neutral duration to take advantage of potential change in the minds of central banks from rate hike cycle to keeping rates flat, even maybe for some to start cutting rates again in 2027. The short end is likely to benefit more, but at the same time, because of the stronger or at least the more resilient global economy, we would argue that high-yield corporate debt continues to be a really worthy assets to occupy the spot in terms of portfolio allocation. If you look at, for example, the rate of defaults, that continues to be low. And as a result, spreads are tight. There's no two ways about it. Corporate credit spreads are tight, and the room for further tightening is very limited. And therefore, we're not expecting a huge amount of capital gain from high-yield corporate debt. But when you look at all-in yields from high-yield corporate debt at 6 to 7%, even higher for other categories of non-investment grade debt, that to me is still a very attractive income generator when it comes to fixed income. So that's one option. The other option, again, something that we've been flagging for the past 12 months, is options overlay strategies, covered call strategies, where you're basically trying to monetize market volatilities and change that into options premium that complements your equity allocation. So, in the second half of the year, as Kerry rightly mentioned, it could be AI hyperscalers, their earnings outlook, their capex their stories start to become more of a question for investors. You may see more volatilities. the speculative nature of some of the Asian markets, such as Korea, could also be a challenge. And that additional volatility could well be able to generate additional income for investors through a cover call strategy. So I think in terms of income generation, it's not only about fixed income. We also have equity dividends, which is obviously another very popular traditional way of generating income. But on top of that, we also have option strategies that can complement perhaps a more volatile environment. So Gary, I think, excuse me, in terms of income generation, of course, we have a world of private market assets, alternative assets that is available. But at the same time, we do get a lot of questions on the outlook for the US dollar. Where are we going to be? I think we've seen some strengthening of the dollar, which goes against at least my view of a weaker dollar story in the last few weeks. So do we think the dollar is now in a upward trajectory, or other factors that could actually start to pull the dollar down once again? And also, what do we think in terms of private market, in terms of alternative assets, which I think is increasingly relevant and important for investors across APAC?
Yeah, great questions. I mean, the currency one is always one that comes up with investors about what's happening. And I think from earlier in the year, we saw this big theme around, US dollar debasement. The expectation was always that you were seeing a rotation away from wanting to own US dollar exposure. Even if you did want to have US assets, that was quite meaningful in thinking about how you hedge that out of a portfolio. And then more recently, we've seen the dollar actually starting to increase. Maybe some of those debasement fears have moved away. But I think you can break it down to three things that we think about when considering which direction the US dollar would go in. The first is rate differentials. The second is growth differentials between the US and the rest of the world. And then the third one is that sort of institutional stability, which really comes back to that debasement idea. So on those, I mean, the rate differential has been, I think, one of the meaningful ones more recently. There was an expectation that, Kevin Warsh was quite dovish. He was coming into the Fed. It was always about outlook for easing policy rates. And then, his first meeting was actually relatively hawkish. It actually, in fact, was quite hawkish. He was very clear about focusing on wanting to get inflation back down. You had a dot plot that was pretty evenly split between wanting to see rate hikes coming through this year and not moving on rates as well. And so the market started to reprice for those higher interest rates relative to the rest of the world. That rate differential went up, that supported the dollar. And so even though we think about the ECB moving higher on rates, the Bank of Japan moving higher on rates, that movement in terms of the market expectation around the Fed really supported the dollar in that environment. And then we've also had that growth differential as well. So the US has been very resilient despite this energy shock around the world. The consumer has been doing still fairly well. Obviously, that CapEx tailwind's been very strong in some of the GDP figures. But now we're thinking about, again, the growth outlook for the rest of the world getting a little bit better as these headwinds fade and the benefit of that CapEx starts to broaden out. So there you have those first two things being challenged. The market unwinding some of that expectations around a rate hike from the Fed, but still considering, and we would think in our view, the ECB moving again, and the Bank of Japan obviously trying to do something as well. And so you might see that rate differential start to narrow again. That growth differential may start to narrow as the rest of the world picks up in terms of growth. It's not great growth, but it's picking up. And then also that institutional instability. I think one of the other things the market took away is the idea that, the Federal Reserve is still very much an independent body. They're changing the way that they operate, but they're still positioning themselves to be independent from the US government administration, and that's very, very important for addressing some of those concerns around that debasement fear. So I think that's the things that have been moving the dollar higher. But again, we would see those starting to come out and would expect that dollar to probably be unwinding some of that strength and probably flat across the course of this year. So very difficult to pick directions of currencies in the short term, but in our mind, those are the three big factors. And I would state that, longer term, we think about some of the other structural forces in the US economy. The dollar does look overstated in terms of value. And so we do have that longer term view around depreciation in the currency as well. And just to your other point, Ty, coming back to the public markets versus private market side, obviously a huge amount of interest in private markets on the infrastructure build out, the energy story, all of that thing that goes into by thinking about energy resilience, reliability, the power that's required for these data centers, the build out of everything that goes with that to support the grid has been a very dominant point for investors wanting to, again, think about building in uncorrelated assets to their portfolios. A lot of focus on hedge funds as well, given their ability to take advantage of the volatility in the market, as well as those higher cash rates, which do support their returns. And thinking again around some of the opportunities within private equity as well, given you've seen a pickup in exit activity, and obviously most notably some of the very large IPOs we've seen come to market this year, and expectations for another couple of big ones, which would make this year one of the standouts in terms of IPOs overall. And this does come with, somewhat of a pushback, because we look at this chart new to the guide for this quarter. You've got North American M&A activity on the left, IPO announcements on the right. Typically, a lot of M&A activity has been sort of associated with the end of the market cycle. It's something that happens very late in the cycle, sometimes pointed to as being a reason to think about things coming to a draw. I think it's more a sign of the markets having the strength, the economy having that resilience, which has seen that M&A activity pick up, and the IPOs really around this tech story, again, being something of a growth story for thinking about these private companies which are needing to grow faster, looking for new sources of capital and looking to bring themselves to the market to take advantage of that as they grow. So I think it does create an opportunity for investors who haven't been available or associated with the private side of these companies. And again, it can raise these concerns around what it does to indexes. You have these big companies come through. I think there's lots of structures in place that kind of limit that over time, and we're seeing that with what's happened at the moment in terms of how much shares are being issued and how they're staggered to come through, and how that can mitigate some of the concerns around index composition. But I would state, I think the big takeaway here is that as these public companies or private companies go public, they have to make a lot more of their financial statements transparent. They have to bring a lot more of that information to fore. And then we think about AI as a secular theme, these big private companies that are going to be the model producers as they go public, you're going to have a lot greater clarity on exactly what that revenue stream looks like, how that monetization works, how that supports that capex, and actually can really much support an ongoing theme around AI as these players then sort of continue to invest and grow to become the dominant platform. So I think a lot of that transparency that will come through will actually be quite supportive for thinking about the ongoing AI theme. But as we always say, a lot of the growth happens when these companies are still private. They're staying private a lot longer. It's now about 14 years on average, and they're getting a lot bigger before they do go public. So the bulk of that growth is still happening when they're in the private space. A lot of this is going to be quite positive, thinking about investments in private equity and small caps, investments in the VC side of things. We're looking for that next AI leader that will be there in the future. And so I think it's quite a good trickle-down effect in terms of the private equity landscape overall. So we're still very positive on thinking about private markets for that diversification, that income story from transport, from infrastructure, the growth that comes within the private equity space, and some of the diversification benefits as well there as we think about hedge funds. So lots of opportunities overall in private markets still tie in this environment, even though all the focus has been on what's happening in public markets so far in the first part of this year.
Thank you very much for your patience and staying with us through the call. As always, any feedback, any comments, any questions, please reach out to your JP Morgan Asset Management client advisors, or you can reach out to myself, Kerry, or any of our global market strategists with the Market Insights team. We'll hopefully get back to you as soon as we can. We do have another call later in August with the next FOMC meeting. And at the same time, we have plenty of materials from On the Minds of Investors, from our podcast, as well as the Guide to Alternatives, which Kerry will deep dive into the world of alternative assets. Thank you very much for joining us, Kerry. Thank you for your time and insights as always. Always a pleasure to partner up with you. Have a great weekend, and thank you very much.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.